So far, we've looked at 5 of the 6 steps involved in building an individual disability policy. We've discussed how to calculate the need for disability insurance. We looked at morbidity and occupation classifications. We looked at 3 different definitions of disability: NEOC, regular OC, ONOC. We looked at building the contract. We looked at non-cancelable, guaranteed renewable contracts. We looked at guaranteed renewable contracts. And we looked at cancelable or commercial contracts. We looked at different ways to structure the benefit period. We saw an elimination period or waiting period at the beginning of the policy, and a benefit period to tell us how long claims could be paid for. The final step that we're going to look at, the 6th step in building disability insurance, is going to be looking at the riders, waivers, and benefits that we can attach to a policy. Now, riders, waivers, and benefits are features that we can add onto the policy to customize the policy to our own individual needs. Think of this like acquiring options on a brand new car. You go to buy a new car, you say, you know, I live in a cold environment. It might be nice if I could get in my car in the winter without getting a cold bum. So I'm going to acquire heated seats for my car. You buy heated seats, it's going to cost you something extra, but now you have something that meets your particular needs with the car. When we're buying insurance policies, we can do something similar. We could add on these riders, waivers, and benefits to customize the policy to meet our particular needs. Now, there are several different riders, waivers, and benefits available with disability insurance, and you'll find that different insurance companies offer a different selection of riders and waivers and benefits, and they go by different names depending on the insurance company that we're dealing with, but the ideas are roughly the same. We're going to look here at 5 of the more common riders that we can add on to a disability insurance policy. The first set that we're going to look at is what's called the future purchase option, or the future income option, or the future income benefit, or the future purchase benefit, or the future income rider, or future purchase rider, whatever name it happens to go by. It's always going to have this idea of being able to buy more in the future. So imagine that we have a business owner. And let's say that our business owner is at the age of 28. And at 28, this person has built their business to some level, enough that this person is able to take a regular income out of the business. Let's say that this person is taking $50,000 a year per annum or per year of income out of their business. Now, we would expect that if our business owner achieves some success, that their income should grow over the life of the business. So ideally, we would see their income do something like this. However, this person buys their disability insurance when their income is at this $50,000 a year level. So what we'll find now is if this person's income increases, let's say we get to $60,000 and later to $70,000. So this person's income increases. Well, if they become disabled over here when their income is $70,000 a year and they bought a disability policy based on $50,000 of income, when we generate claims for them, the claims are going to be based on that $50,000 of benefit that they're actually paying for. We don't automatically increase your coverage as your salary increases. Rather, this is the policy you bought. This is the benefit that you'll receive. So their disability income would be this on a monthly basis times 50, 60, 65, 66 2/3, or 70%, whatever their policy happens to dictate. Now, that might not be attractive. Our business owner can clearly anticipate that their income is going to increase, assuming that all goes according to plan in the business. So what our business owner will likely do when they acquire their disability policy is they will add on this future purchase option. It'll increase the cost of their policy, usually by somewhere around 20 to 25%, so it's not an inexpensive rider to add on, but we're going to see that this could be very valuable for our business owner. Because what happens now is, let's say this happens at age 31, so at age 31 now they're making $60,000 a year. Well, what they do at this point is they provide proof of that new income to the insurance company, and the insurance company increases their benefit accordingly, without any kind of medical evidence. So even if this person's health is deteriorated in some way, or they've taken up some sort of a dangerous hobby, whatever you happen to have, this person will not have to provide any kind of evidence except evidence of that new income in order to increase their benefit to that amount. Now, when they do that, their premiums will increase because they're getting more coverage. But their premiums will increase based on $60,000 of income and their insurability back here at age 28. That's the only insurability information we have to go on. We're not collecting new information here. And then let's say that this person gets to age 35, and at age 35, here we are again. This person has $70,000 of income now. They say to their insurance company, I'd really like to increase my amount of coverage. Great, no problem. You bought that future income option or future purchase option. Increase your coverage. You're in good shape. You don't have to give us any evidence except of that increased income. So, let's say that this person has gone through all those steps, and now they get here to age 35. And at age 35, this person becomes disabled. And they start to receive benefits. Now, for whatever reason, the nature of their disability is such that it doesn't become obvious to us that they're going to be disabled for a long time. Maybe they bounce off and on claim. Maybe they have a series of recurring disabilities. Maybe they have some sort of a condition that we expect to subside and it never does. Whatever happens here, this person ends up on claim for a good long time. We know that most insurers, if they recognize that this person is going to be disabled for a long time like this, most insurers will pay a lump sum at this point. However, this insurer doesn't recognize this, so instead, what we have here is we have $70,000 of income as the basis for the disability benefit, and this person starts to receive this benefit for a long, long time. Now, let's say that they're still getting a benefit of $70,000 a year. Based on $70,000 a year, they're still receiving the same benefit over here at age 50. There's going to be a problem here because between age 35 and age 50, they'll have had 15 years of inflation that they will have had to deal with. So what will have actually happened here, yes, they'll be getting $70,000 worth of benefit. That won't have changed. However, what you can do with $70,000 will have changed because of the effects of inflation. So what insurance companies will do is they will sell you another rider here. They'll sell you a rider called a cost of living rider or cost of living adjustment. And that cost of living rider or cost of living adjustment will allow your benefits to increase to keep pace with inflation. So that now we have a benefit that will stay with you, or that will continue to grow with inflation. It'll stay with you at its inflated amount, allowing you to continue to live comfortably without having to fight the effects of inflation. And of course, it would go beyond age 50. It would carry on right up until the natural benefit period of the policy, whatever that happens to be. The next set of riders we'll look at are the waiver of premium rider and the rehabilitation rider. Now, the reason we'll look at these together is because we find that many insurers will automatically include these in their disability policies. So the waiver of premium rider, what happens here, you become disabled, suffer your disability, and the insurance company says, okay, we get it, you're disabled. Now, you're going to have a period here. Usually with waiver of premium, it's going to be 90 days. And during that 90 days, you are going to have to pay your own premiums. So during this point, the policy owner pays those premiums. At the 90-day mark, though, what's going to happen is if you have this waiver of premium, now the insurance company will pay your premiums for you automatically. So now, instead of you paying the premiums, the insurer pays those premiums for you. And in most cases, they will also go back to your premiums that you paid during that elimination period for the waiver of premium, and they will actually repay those for you. So you'll have those retroactively paid back. This can be fairly attractive, and the insurance company likes this because it reduces the chance of the disability policy lapsing. The insurance company wants you to come back off claim and go back to paying premiums. That's how they make their money. The next benefit we'll look at is rehabilitation benefits. This is fairly straightforward with rehabilitation benefits, which we generally do see included automatically in disability policies today. The insurance company will help to retrain or rehabilitate you to get you back to work and get you off claim. The last of the riders that we'll look at will be the return of premium rider. So here's what happens with return of premium. We have our policy owner, let's say age 28, this person acquires their disability policy. And let's say they go from 28 to 65 paying premiums that whole time. And they never have a serious disability. Maybe they have a little disability somewhere along the way, but nothing serious, nothing that requires the insurance company to pay them out a whole ton of money. So they never have a serious disability during this whole time, and yet they've been paying premiums here for 37 years. Now you get to age 65, what do you have to show for 37 years of having paid premiums? Well, peace of mind, right? But you can't spend peace of mind. So what you could do is at the point where you acquire the policy back here at age 28, you could add a return of premium rider. And now, having that return of premium rider means that at age 65, you're going to get some portion, maybe 50%, maybe 100%, whatever your policy happens to dictate, you're going to get those premiums back. So those now are returned to the policy owner. Well, how does the insurance company make any money off that? Well, here you were at age 28, let's say paying premiums of, $800 a year. And now, at 65, the insurance company is going to give you back $800 for age 28 and the same amount for age 29 and 30 and so on. What was the insurance company doing with that $800 for that 37 years? Of course, they took that money and invested it. And they're going to happily take the returns off the $800. You get your $800 back, assuming there was a 100% return on the premium of the policy, which we don't always see. Sometimes it might be just a 50% return of premium, for example. So we've looked now at the 6 steps to building disability insurance, and I would encourage you to learn disability insurance in that manner. A lot of folks in the industry stay away from disability insurance because they find it too confusing, too complicated, and it is, in fairness, a complex product. There's a lot to know about disability insurance, and it takes us in some areas that maybe we're not comfortable with if we're really familiar with life insurance or retirement, for example. So I would encourage you, though, to learn it in that 6-step process, and the first time you go out in the world and you're sitting down with a client and selling them disability insurance, follow that process. It will help you to build a logical policy that will help to meet the needs of the client. It'll also serve you well on the exam, and I wish you good luck then going forward. Thanks for joining me again in this presentation of the LLQP video series.